So this is, I think, a really interesting one because I get asked this sort of question or in and around this question a lot. So we're going to talk about, it's a coach's corner, the 3 biggest mistakes traders make, and a lot of the time they don't even realize they're doing it. So the first one is over trading.
Yeah, I mean, they're all common mistakes, and over trading is, yes, we've got that typical, someone who's there clicking away all day long, and they're over trading. But there are also the subtle types of over trading as well, aren't there? So
Yes.
you've got the traders who might actually be swing trading, and they're sitting there thinking, oh, I haven't done a trade all week, and then they're out there looking for trades rather than allowing the trades to come to them. They're forcing it, and then they're going and saying, well, that market's moved over there, I should do something, rather than doing their analysis first, or if they've got a particular strategy and then just allowing it to come to them. They just feel like they've got to do something. So that's another form of effectively over trading, that people feel like they need to be doing something.
I think you've hit the point that I see a lot, is this feeling like, well, if I'm not actively in the market, I'm not doing something, or I'm not trading, then I'm either missing out, or whether it's due to the psychology of people feel that they need to be productive, they need to be busy, and if the only way they're going to make money is by trading. But what you also said was really interesting, was you've got to let the trade come to you. And that was one of the first phrases that really hit me years and years ago, rather than be chasing down a market, chasing down a trade. And I always link it to that feeling that if you feel you're rushing get into a trade, or you're rushing, or you're chasing something, it's probably the wrong trade. And that feeling of waiting for the trade to come to you is a really important one.
And I think it affects all of us as well. Yeah. We were just talking off camera about yesterday. I'm in a position that I've been in, and I've accrued, built up this position over time. And so adding to your winning trades is, I love that style of trading. But when you're adding to your winning trades, it does mean that your average entry price is coming up. And so you're not moving away from risk or from a stopping away, because your average price is coming higher. So it doesn't need to roll over too much, and you're back into having a losing trade or whatever. But it is highly profitable. But there are, like with any style of trading, there are consequences to whatever style it is. That's a consequence. If a market then decides to do a larger retracement. Anyway, the markets all of a sudden got really volatile yesterday. And I'm looking at it and I'm thinking, oh, maybe I'm going to have to do a hedge. So all of a sudden, I've got a trading decision to make here, which I didn't plan out for. Talking of over trading, and I'm saying to my traders, okay, let's just take the rest of the day. Let's see what the price action's like. I'm having to get myself into that modality of, do I want to place a hedge? And because otherwise, if you just react, then it's another form of over trading. If I'd have just reacted, said, right, okay, let's do it. Whoa, hold on a second. I've built up this whole position over a month. Do I want to put this hedge in? What size hedge? Does the hedge have stop losses in it? There's a lot to, am I comfortable if the hedge doesn't work? You've got to process all of that. So that's why I'll still spend all of that time to pose all those questions to myself, because I don't want to overtrade. So even what I'm talking about there is a form of potentially over trading. As it happened, I didn't have to hedge.
Yeah, it's very, and I think that's key. Is often it's quite subtle. When I'm working with traders, a lot of the time they'll say, oh, what's the average trade frequency on this strategy? And it might work out as 2 trades, let's say 2 trades a week. But a lot of the time I think people work in the form of average. They see it as, well, it's an average of 2 trades a week, so their expectation is 2 trades a week. But actually you might have to go 3 or 4 weeks without either doing much, or wait through a couple of weeks waiting for a trade, and then it's like buses. You get 3 or 4 at once, or you might be in a trade for a short period of time, and then a position takes longer. And I think what causes over trading sometimes is people expecting almost to work in a linear way, and actually, you can be in trades for weeks and months if that's what the market's doing.
I had a question on this this is one of the questions that raised this subject. He said something like he'd got a strategy that gave him on average 20 trades a month, and he said, if I add this extra market in, or extra strategy, that would give me an extra 10 trades, and then that would build my profitability, and it comes like this whole thing of over trading, and people are seeing the rewards but not thinking about the risk that's going to
Exactly.
come with those. And you said off camera earlier on something really good in that regard.
Yeah, so the second one that we've got overtrading as biggest mistake number one. Mistake number two, which you've led on to, is too many markets. So I have this saying that more markets means more losers. And it's just a mental reminder, because most people, when they look to add a market to their strategy or add multiple markets to what they're doing, they're thinking about the end profitability. The classic one is, well, if I'm trading 3 markets and I add another 3 markets, potentially I can double what I'm making. But actually, if they force themselves to think, if I increase the number of markets, I'm effectively increasing my trade frequency, which is going to mean more losers to cope with, and be mentally, it's mentally more demanding. And it's just reminding traders, don't just think I'm going to make more money because I'm trading more often.
No, exactly. Yeah, more frequency doesn't necessarily, or certainly it can mean more money. You know, when you look at the end of the year or end of a 2-year period or whatever, you're going to have bigger drawdowns. It's going to come with that. The more trading frequency or more markets that you're trading, the higher likelihood of deeper drawdowns. And then you have to ask yourself that question. Am I comfortable with that? Am I going to, and you really have to immerse yourself in, okay, if I'm going to have a 10% drawdown, to really envisage that 10%, to say, how comfortable would I be with a 10% or a 20% drawdown? Because if you want to be making 100% in a year, because that's what a lot of people want, what they don't realize is that if you want to make 100% in a year, are you comfortable with a 40% drawdown? Because that's the potential, if that's, you know, the potential risk.
That's the price you're going to have to pay.
Yeah, exactly.
And I think it's also the other challenge as well, and we were discussing this off camera, is that people can add more markets. So, for instance, I trade more markets than you, but I'll probably look at less. I'll have less entry options. So I might be a little bit tighter with the entries that I'll allow myself to trade. Like I may only trade a pullback entry. I might not trade a breakout entry on that. So having more markets is fine if you're not necessarily looking to trade different entry styles. So I think it's important what you said about, yeah, it's fine adding more markets, but think about how does that fit into your overall trading plan?
And I think we talked about this as well. Lots of things we talked about this morning. But if you're using an algorithm or something, or a scanner to scan 20 or 30 markets for you to then present to you the opportunities or whatever, that's one thing, you know. But if you're manually scanning through 20 or 30 markets, you've got to ask yourself again: are you potentially going down that route or that path of, again, overtrading, too many markets, too much to think about? But like you just said, if you've got a low frequency strategy, you need more markets in order to, because you're still not actually doing a lot of trades. You need that, that number of markets in order to gain at least some trades. But I think it's a balancing act.
Very much so.
I think a lot of people do is they end up looking at too much. So I think the main piece of advice is, we talked about this in previous shows, whatever it is you're looking at right now, ask yourself the question, could I do less?
Yeah,
and that whole less is more philosophy, it runs throughout trading. And Jim Rogers, the billionaire investor, George Soros' old business partner, always said, you make your money sitting on your hands.
Yeah.
And I think that the more traders, whether they're intraday trading and or they're swing trading, look at what you are doing and say, could I reduce it by 10%? And what would that? It might be that your drawdowns are slightly less. It might be that you're less stressful. Because a lot of people get stressed by their trading.
Exactly.
So there's lots of things to consider when it comes to overtrading and potentially too many markets.
Too many markets, yeah. And too many markets can be a stimulus to just be trading too much. It can be an excuse, yeah. And then our last one, which is risking too much. So the percent you risk on a trade, this is one that we both get bombarded with. Hypothetical scenarios, and you've got a great one, the 8% story.
Yeah, I've had loads recently. See, I must have done a video on risk, and I've had, again, there's nothing, people are just innocently asking these questions, and it's quite right to ask these questions.
Better they ask than don't. Yeah.
Absolutely. I had one person who was looking to join my trading community, and he'd emailed into Sam, and he said, I currently risk 8% per trade, but I'm comfortable with increasing that once I come into Charlie's community and I follow his trades. I'm thinking, Oh my
You
God.
don't want the responsibility of somebody risking 10% a trade.
Yeah,
Isn't it
8%.
interesting?
It's crazy. And so, what people think is acceptable, now that one's a bit more extreme. Forget the people who don't even use stop losses. At least these people are
Yeah.
using stops. But a lot of people seem to say, is 3% risk per trade or 4% risk per trade okay, or 5%? 3 to 5 seems to be quite common, or 2.5. Once you get south of 2, then there's more of an argument can be made.
Yes.
But I would still say that for most people, they're probably risking too much.
Yeah.
And you hear all these stories of people saying, oh God, I felt nauseous on the back of a losing trade. You shouldn't ever
Never
be
feel that. No.
like that. If you are, you're risking. Even if you're risking 1% and you feel nauseous, cut it to 0.5%, because for you at that point in time, it's too much. Sorry, let me.
No. I think that's really good, because a lot of the time we can be wary of using the word feelings, because you want to be systematic in your trading and you want to keep emotions out of it. But actually being aware of how you feel about the risk you're using, because you might be managing risk effectively from a numerical point of view, 1% risk per trade, but for you at that point, it's just that little bit too much. So being aware of how you feel, I think, is a really important distinction. But also, I think it's relative to the amount of trades you're placing, which links back to how many trades you place. So, I've had people come and say to me that they feel that they're being very risk averse by risking 1% per trade as a day trader, and they're placing 7 or 8 trades in a day. And I'm like, well, to me, that's actually, should be looking at 0.5% or 0.3%. And very often what happens is, even if I say I think you should be risking less, well, they see 1% as conservative, and then 2 months later I speak to them and they're like, I'm risking 0.5% now, Ali, because they haven't been able to deal with the trade frequency and the inevitable losing periods that they were going to have, and they've ended up having. So I think that's it's also about the number of trades you place, and relating it to how you feel is very important.
Intrinsically linked. They're all linked, what we're talking about here in this subject. But coming back to the day trading, you're risking 1% per trade. And you've got day traders who are risking 2% per trade as well. Yeah. My word, you've only got to have a few losers, and on successive days, which can happen. The markets go through funny periods for all traders, where they're just all of a sudden all over the place, and whatever your approach is can just be out of sync with what the market's doing, and very quickly you're down 15% in a week. And you're like, wow. And to me, it's like, wow.
Finishing on a Friday, 15% down, it's going to impact your weekend. It's going to impact your thought process, and it probably impact how you trade on the Monday.
100%. But again, coming back to risk, I think one of the inherent issues with when people are asking, should I risk, can I risk 3%, 4%, 8% per trade, it comes back down to the need, the desire to increase the size of their account, because a lot of the time they're trading on smaller accounts, and that's the embedded issue that we have constantly, and that's why all these funded account programs are out there to lure people in. Oh, you haven't got enough money yourself? Here's 100,000. Yes, we're doing it from the goodness of our heart, and there you go. Anyway,
you've had 1 month of successful trading. Here you go. Here's
So that is a genuine issue. So someone's got whatever, $1,000, $2,000 in a trading account, and they're like, well, I need to get this up because I want to make it more tangible. So you can understand why they want to risk 3% per trade. And it doesn't feel, I had someone say to me, it just doesn't feel a lot when I'm making the money or the losers, because it is only a small account. But they've got to look at it from a percentage return perspective. Even if they are risking 0.5%, 1%, they can end up having some great percentage returns. Yes, it might only make on a 2,000 account, you might make $1,000 at the end of the year. And you're like, well, I can't live off that. No, you can't. But that's an amazing return.
Exactly.
So
I have people say to me, what am I doing with the rest of the money? Because I'm only risking 2%. It's amazing how, like you said, people with less experience see 3% as uber conservative, because whether they've come from an investment mindset where their entire investment portfolio is invested. It's a very different concept, and I think that leads on to something we've discussed in the past, which is where sometimes for certain traders, I worked with a guy once who was earning a good wage, and it was in the 80-90 grand bracket. This was probably 8-9 years ago, but he only had a couple of grand in his trading account, and for him, the problem was he was over trading, he was risking too much per trade, he was breaking his rules, because the wins and losses weren't enough for him to be disciplined. He actually wasn't respecting his account enough.
RASPECT. See what it means to me. I don't know what
He's been trying to do that.
Bit of a Aretha there for you. That one, you can have that one for free. So, yeah, he's not respecting his account. You're absolutely right. So, I've seen that over the years as well. And they'll happily blow a few £100, and you've seen this with the crypto crowd. You know, they'll put a few £100 into onto an app, load it up, hit a crypto, blow it up, and then reload it. It's the same sort of thing that goes on. They don't respect the money. So again, they have to think, well, actually, I may only be trading on whatever the capital is, but they've got to treat it as if they're
trading more. And in his scenario, actually, you made the suggestion that he should invest, he should trade with more money and it worked. Yeah, because it suddenly became the losses suddenly woke him up, because 10 quid here, 20 quid there wasn't enough for him to stay disciplined for long enough. But actually, when the losses were a little bit more tangible relative to the amount of money he had, he started being more disciplined. So.
It's a valid point. So what do we want to? How do we want to summarise this as far as advice is concerned? Risk less, do less.
Do less. Yeah. Risk less. Trade less markets. Don't trade as much. There you go.
There we go. So less.
Less is more.